Friends, when you first look at investing, everything seems on screen. Charts rise, numbers fall, trying to predict the move.
But the real side of investing does not begin on the screen. It begins inside the investor's mind. Because the money you put into the market is not only capital.
It is also a mirror that tests your patience, your fears, your discipline, and your ability to think long-term. Today, we will talk about the 8 stages investors go through. But this is not only about how much money you have. The real difference in investing is not just the size of your capital, it is how your thinking changes as that capital grows. Someone investing with a small amount of money thinks one way. Someone with a $100,000 portfolio thinks differently. And someone managing millions thinks in an entirely different way. At some point, investing stops being only an attempt to make more money. It becomes the art of managing capital with awareness, structure, and discipline.
The first stage begins when you open your investment account. Maybe you enter a brokerage app for the first time. You see company names, prices, charts, buy buttons, and sell buttons. From the outside, everything looks simple, but what you feel in that moment is not simple, because you are no longer just watching from the outside. Even with a small amount of money, you have entered the game. Maybe you deposit your first $500. That amount may not change your life, but it matters to you, because now the price movements on the screen are no longer just numbers you hear about in the news. They are connected to your own decisions. When you buy a stock, you slowly begin to understand something important. You are not only buying a price, you are buying a small piece of a real business. That idea sounds simple, but it takes time to truly understand. Because the first lesson of investing is this: before you focus on the price of a company, you need to understand what that company actually does. How does it make money? Why do people use its product or service? Is it truly growing, or is it only getting attention because the market is excited? At this stage, you read a lot. You listen to different opinions. Some people talk about short-term price movements. Others talk about value, revenue, competition, and the future of the business. And this is where you see the first major difference. Some people try to guess where the price will go tomorrow. Others try to understand what they actually own. At this stage, your returns may be small. Sometimes, instead of profit, you may only feel confusion, but that is normal. Because the real gain at the beginning is not money. The real gain is learning to think like an investor. After a while, you understand that investing is not about reacting to every movement. Investing is about staying with the right idea long enough for time to do its work. The second stage begins when investing stops being a one-time excitement and becomes a habit. You no longer wait for the market to feel perfect. You no longer ask whether everyone is optimistic or afraid. Every month, you transfer a certain amount into your investment account. It may be $500, it may be $1,000, it may be less or more. The amount matters, but the habit matters more. Because in investing, one of the strongest advantages is the ability to act consistently. At this stage, you stop spreading your money randomly. Part of your money may go into broad market funds, part of it may go into sector-based investments, and part of it may go into individual companies you have actually researched. Your portfolio slowly stops being a scattered list. It starts becoming a structure, and this is where you begin to understand diversification more clearly. Diversification is not simply owning many different assets. Real diversification means owning assets that can behave differently under the same conditions. Then the market falls. This is inevitable. Your portfolio loses value too. And this becomes the first serious test of investor behavior. Because on paper, everyone is a long-term investor. But when the portfolio turns red, a person's real character begins to appear. At this stage, you learn something important. Volatility is not always the danger. The real danger is making the wrong decision because of fear. Instead of selling in panic, you stay with your plan. You continue investing every month, not because you are trying to find the exact bottom, but because you are building capital over time. The third stage begins when your portfolio reaches a meaningful size. Imagine crossing $100,000. This number is not only financial, it is also psychological. Because now, even small percentages represent real money. When your portfolio moves by 1%, it is no longer just a tiny movement on a chart. It is $1,000. If the market has a strong year, your existing capital can begin to add a serious amount to your wealth, even before you make new contributions. For the first time, you feel something more clearly. You are working, but now your money is also beginning to work with you. At this stage, your strategy becomes more defined. You begin deciding how much of your portfolio should be in each type of asset. Stocks may provide growth. Bonds or fixed income assets may bring balance. Cash or short-term holdings may give flexibility. But the most important thing is not the exact percentage. The most important thing is whether you can stay loyal to the plan when your emotions change. When the market rises, you do not become recklessly confident. When the market falls, you do not become helplessly afraid. You begin rebalancing your portfolio from time to time. If one part grows too large, you reduce it. If another part falls behind, you bring the system back into balance. This is where investing begins to mature. Because you no longer ask only, how much did I make? You begin asking, how much risk did I take to earn this return? Return matters. But the volatility, uncertainty, and potential loss behind that return matter even more. At this stage, market corrections no longer completely shake you. You begin to see them as part of the process. The fourth stage begins as your portfolio moves toward the range between $250,000 and $1 million. At this point, the tone of the game changes. The goal is no longer only to build wealth. The goal is to make the wealth you have already built grow more intelligently. At this size, small differences can create large results. 1 or 2 extra percentage points in annual performance may no longer be a small detail. It can mean thousands or even tens of thousands of dollars. At this stage, your investment decisions gain more layers. You no longer ask only, will this asset go up? You ask, what role does this asset play in my portfolio? Does it reduce my risk or increase it? Does it generate income or provide growth? How might it behave during difficult market conditions? Does it truly serve my long-term goals? These questions change the level of your investing. Stocks may still be important, but they are no longer the only center of the portfolio. Fixed income assets, real estate, cash positions, alternative investments, and different strategies may all become part of the system. Each asset begins to have a role. Some are for growth, some are for stability, some are for income, and some are there to help you remain prepared for unexpected periods. Tax efficiency also becomes more serious. Where you hold an investment, when you sell it, and how long you keep it can all begin to matter. Because in investing, it is not only what you earn that matters, it is also how much of it you are able to keep. The fifth stage begins when your investable assets pass $1 million. This level changes not only your portfolio, but also how the financial system approaches you. You are no longer limited only to the markets everyone can access. Some doors begin to open. Private equity opportunities, venture capital deals, real estate projects, private funds, and non-public investments may start appearing. But more opportunities do not mean easier decisions. In fact, the game becomes more complex. These investments often require higher minimums, longer holding periods, and lower liquidity. The sixth and seventh stages are where investing becomes a professional function. At 10 million, 100 million, or even institutional scale, decisions are no longer only about personal returns. They influence how capital moves. And at the billionaire stage, scale changes everything. Capital no longer only participates in markets, it can influence companies, sectors, and even the direction of entire industries. In the early stages, you react to the market. In the final stages, the market begins to react to you. Friends, no matter which stage you are in, the greatest test remains the same: managing your own behavior.
Real investing is not only about making more money, it is about making better decisions. I'm Martin. We will continue to understand money, markets, and human behavior together. See you in the next video.